America has been hit by high unemployment and inflation. Red alerts have been sounded over the US's economic growth, and it plans to battle this in the next week of September.
I believe it is important to start the rate cutting process at our next meeting. If subsequent data show a significant deterioration, not softening, but deterioration in the labor market, the FOMC can act quickly and forcefully to adjust monetary policy.
Our restrictive monetary policy helped restore balance between aggregate supply and demand, easing inflationary pressures and ensuring that inflation expectations remained well anchored. Inflation is now much closer to our objective, with prices having risen 2.5% over the past 12 months. After a pause earlier this year, progress toward our 2% objective has resumed. My confidence has grown that inflation is on a sustainable path back to 2%.
I am open-minded about the size and pace of cuts, which will be based on what the data tell us about the evolution of the economy, and not on any preconceived notion of how and when the committee should act. If the data supports cuts at consecutive meetings, then I believe it will be appropriate to do so.
Which would be a very crucial week for global as well as Indian stock markets. Now, why is this significant and how could it affect global markets and India? Well, stay tuned till the end to understand the impact and hit the subscribe button if you haven't already. Now, America is all set to cut its interest rates for the first time since 2020. Jerome Powell, who is the chairman of the United States Federal Reserve, has hinted strongly that the US central bank is prepared to start its interest rate cut cycle. Let me give you some historical context. Now, post the lows of the COVID-19 pandemic, the governments infused liquidity to boost the economy, which led to higher prices, or also called inflation. Now, to combat this, central banks raised their interest rates from the period of 2022 to 2023 to curb the inflation by slowing economic activity and reducing demand. However, prolonged high rates can also harm the economy, potentially leading to recession, suppressed growth, and higher unemployment. This is what the US has been experiencing lately. Now, however, the US Central Bank has successfully brought inflation back to its targets level. Now, as of August 2024, the annual US inflation rate was 2.9%, the lowest since March 2021. Now they plan to reduce the rates so the economy does not go into recession. How does this impact the Indian market? Which sectors could benefit? And will the rupee strengthen? Well, let me answer it all. Let's first analyze how US Fed rates impact global markets. Now, these rates are observed globally as the impact is significant and can affect currency exchange rates, capital flows, stock and bond markets, as well as commodities. Now, as per ICICI Securities, the US dollar tends to weaken when rates are cut. This makes it cheaper for foreigners to buy US goods and services. It can also boost exports for US companies, but also lead to higher prices for imported goods. In terms of capital flows, well, investors may seek higher returns in other markets. This leads to people pulling out their money from the US and investing it in other markets, especially emerging markets like India. Low interest rates can also help economic growth, corporate earnings, leading to higher stock prices as per ICICI Securities. But this impact does vary across different sectors and regions. Well, with respect to the bond markets, well, bond prices generally rise when interest rates fall, making existing bonds become more attractive to investors. Now, this can benefit bondholders, but it can also lead to lower returns for newer investors. Low interest rates make investors seek alternative investments. This can also lead to increased demand for commodities and drive up their prices, since most major commodities like oil and metals such as steel, iron ore, copper and more are denominated in US dollars. Let's now look at how the US Fed rates could impact Indian markets. The first major impact is foreign investments. Where the interest rates were kept high in the US, investors preferred to keep their money in the US due to the higher returns they were getting on US Treasury securities. But the potential rate cut could reduce the yield of such securities, and as a result, investors could explore emerging markets like India for investments with higher returns. This can lead to an inflow of foreign capital into the Indian equities and debt markets, driving up demand and potentially stock prices. However, it is key to note that industry experts do have concerns that the amount of inflows flowing into Indian equities this time may not be as huge due to the high valuations of the domestic stocks currently. Now, while the change in interest rates can impact many sectors in India, I think it's also key to highlight one sector in particular, which is IT. Now, rate cuts make borrowing costs in the US decrease, which can encourage large corporations to expand their IT budgets, thereby increasing order volumes to the sector in India. Another major impact of the rate cut is on the Indian rupee. Like I mentioned before, the US dollar tends to weaken after a rate cut. Now, the second side of that coin is the appreciation or the strengthening of the Indian rupee. This is mainly caused due to a higher demand as investors convert their foreign currency into INR to invest in Indian markets. Well, do let us know what topic do you want us to break down next in the comments below, and stay tuned to NDTV Profit.